Jai Jagannath. Welcome to my today's class on entrepreneurship and startup. Today I will speaking about working capital management, one of the most important aspect of entrepreneurship and business management. Working capital is lifeblood of any organization because without sufficient working capital, even a profitable company may fail. In today's session, we will cover the meaning, importance, dangers of low, excess or inadequate working capital, then determinants of working capital, that is receivables, payables, inventory, cash management, then different estimation methods. So let's start. Entrepreneurship is about converting opportunities, converting opportunities into business and managing the uncertainties and profit. Entrepreneurs often focus on profits, but but forget that liquidity is equally important for business continuity. For this, working capital is required. Working capital management ensures obligations are met while retaining liquidity and ensures profit. Then, meaning and definition. First, in working capital management, first is gross working capital. Gross working capital generally denotes total current assets of the organizations. Next is net working capital. Net working capital is equal to gross working capital minus current liabilities, or we can say that current assets minus current liabilities. Then what are those current assets? Current assets means cash, receivables. Generally, that we already know, but I'm just telling now. Cash, receivables, inventory, etc. In current liabilities means these current assets. Current liabilities means creditors, payables, outstandings, etc. These are all current liabilities. Working capital reflects liquidity of the organization. How the organization is liquid, that is denoted by the working capital of the organization. Then planning of working capital. Planning is balancing of this liquidity and profitability. Right? How to balance the organization's profit with liquid. It may be possible that organization is more profitable, but it doesn't have liquidity. That means it doesn't have cash, it doesn't have that amount of fund to manage the day-to-day operations of the company, but it is profitable. It may be a situation that the organization is liquid, but it doesn't have sufficient profits. So planning of working capital is definitely required to balance this. Otherwise, the organization cannot sustain for long time. Two, working capital should match business needs. Too much working capital means liquidity but low profitability. Liquidity but low profitability means the companies have more funds with it, but it it is, as it is not able to manage the fund properly, companies profit is less. Too little working capital means profitability is good but liquidity is low. So both extremes are risky, and balance of this ensures survival of the organizations. Dangers of excess working capital. Excess inventory involves wastages, theft, mishandling, means barbadi, chori, durpyog, ये सब. Then ideal funds earns no returns, कोई कुछ भी नहीं मिलता, कोई लाभ नहीं मिलता. Then weak or bad credit policy leads to bad debts. Then in total it leads to inefficiency of total operations of the organizations. So excess working capital is always dangerous for an organizations. Dangers of inadequate working capital. Difficulty in executing operating plans. Growth stagnates, unable to meet obligations. Return on investment falls due to underutilization. Then credit facilities lost, goodwill damaged. Next is determinants of working capital. What are the determinants? Nature and size of business. Based on the nature and size of the business, we have to decide what should be the working capital of the organization. Then production policies. What policies company is following for producing the goods? That is also important determinants to determine the working capital needs of the organization. Next is manufacturing process length. How much time the company requires to complete manufacturing of the product. That is also a determinant. Next is growth and expansion needs of the organizations. Next is trade cycle fluctuations. Next is terms of purchase and sales agreements. Then dividend policy, and last price level changes. So these are the determinants of working capital requirement of an organization. Other determinants are operating efficiency, profit level and profit distributions, coordination and control, market and transport facilities, government policies and taxes. These are also other determinants. The first two slides that I have covered, part 1, part 2, those are more main determinants, but these are also other determinants. That is, what will be the efficiency, what will be the profit level the companies like to make, then how much coordination and control is required within the processes, the market and transport facilities available to the organization, then obviously government policies and taxes. Next we'll see types of working capital. Permanent working capital, that is the minimum amount of capital required always to run the business. Next is temporary working capital, which fluctuates with seasonal or short-term needs. Next comes receivable management. Receivable means credit sales, yet to be collected, means credit sales yet to be collected. Then receivable management means optimize sales, minimize bad debts, and balance profitability and risk. It cost is capital blocked, admin cost, collection cost, and other cost related to collection. Next is benefits. Sales growth. Because of this receivable management, our sales will grow, company can earn extra profit, and customers can be retained for future sales. Next is factors. Sales, sales level, credit policy, trade terms. Next is payable management. Payable means obligation to supplier, means obligation to supplier. So accounts payable means purchase often on credit. Types are open account, promissory notes, bills payable. These are. Then determinants are firm size, industry product, seller strength, terms of trade, competition, and risk. Then comes inventory management. Inventory means raw material, work in process, finished goods. Crucial for inventory management is very crucial for 50 to 60% of the current asset. Because in any of the company's current asset, 50 to 60% is only inventory part. So if the company can able to manage its inventory properly, then it can have 50 to 60% control over its working capital. So it is very vital. Key techniques to manage this inventory is EOQ, minimum maximum level, that is reorder level, what we have learned in costing, ABC analysis, JIT analysis, efficient turnover ratios, all this. So inventory management aims at maintain optimum stock, not too high and not too low. So inventory management ensures optimum inventory. So this is more important than payable management and receivable management. Next comes liquidity and cash management. Cash includes cash plus near cash assets. That is, it is not cash, but it is like cash. That is, bank balance is also equivalent to cash. Adequate cash ensures operations continuity. Excess cash invested in securities for return. If you have excess fund available with you, then it is better to invest it in securities, so that it cannot be underutilized with you. It is under some utility. Motives of holding cash. Transaction motive. Daily expenses. That is, if you can hold that much of cash with you which is required for daily expenses only, not more than that. प्रिकॉशनरी मोटिव, इमरजेंसी सिचुएशंस के लिए कैश रखना है. स्पेकुलेटिव मोटिव, एक्सप्लॉइट अपॉर्चुनिटीज. अगर उतना कैश हमारे पास रहना चाहिए, अगर कोई फट से कोई अपॉर्चुनिटीज आ रहा है, कुछ मटेरियल परचेज करना है या फिर कहीं पर इमरजेंसी सिचुएशन कुछ आ गया, उसको फट से वो अपॉर्चुनिटीज़ को ट्रैप करने के लिए मिनिमम कैश भी रहना चाहिए. Compensative motive, that is bank requirements, etc. Then objectives of cash management: make payments when due, minimize idle balances. Factors affecting cash needs: matching inflows with outflows, short costs of cash shortage, excess cash cost, uncertainty in business, procurement and management costs. So these are the factors. Then estimation of working capital. Estimation of working capital involves mainly these contents, that is inventories, debtors, cash, prepaid expenses. Less creditors, outstanding wages and overheads. So formula is current assets minus current liabilities. So working capital formula is current assets minus current liabilities. These are the current assets and these are the current liabilities. Computation methods. Raw material inventory. This is raw material inventory is based on consumption and holiday holding requirements. Consumption and holding requirements. Work in progress. This depends upon how much processing time is required to convert the raw material into finished goods. This is then finished goods. Stock before delivery means whenever delivery is required, then only stock. Debtor based on the collection periods. Then creditors based on the credit period. Then overheads, टाइम अलाउड फॉर पेमेंट, कितना टाइम के अंदर उसको पेमेंट करना है. लास्ट कम्स कंक्लूजन. सो वर्किंग कैपिटल इज द लाइफ ब्लड ऑफ बिजनेस. Both excess and shortage are harmful. Balanced working capital ensures liquidity, profitability, and efficiency, goodwill, and long term sustainability. So, ultimately, we can tell that working capital is very much important in any organization, because if you will not maintain the proper working capital ratios in your organization, so your liquidity and profitability will not going to help you for future running of the business. So this is very important topic to understand before starting of any business